Here's a shocking fact. Many Washington state public employees are paying thousands more in taxes than they need to. If you're a member of PERS, TERS, or LEOFF, you have unique tax advantages that most financial advisors don't even know about. But there are three critical mistakes that could be costing you money right now. Hi, I'm Seth Thiel with Life Focused Financial Advisors, and I specialize in helping Washington state public servants maximize their retirement benefits. Today, I'm going to show you how exactly to avoid these costly mistakes and keep more of your hard-earned money. Let's dive into mistake number one: missing out on tax gain harvesting. This strategy is particularly powerful for public employees approaching retirement, and here's why. If you're like a lot of my clients, you've built up investments outside of your DRS pension and DCP. This creates a unique opportunity that most people miss. Let me show you how this works with a real life example. Meet Sarah, not a real name. Sarah is a PERS 2 member planning to retire at 62. She'll receive about $4,000 monthly from her pension, but here's what makes her situation interesting, and it might be similar to yours. Sarah is actually planning to wait a year to start her pension because of her other savings. As a result of this, she has a perfect window for tax gain harvesting. In 2025, married couples filing jointly can realize up to $96,700 in capital gains at a 0% federal tax rate, depending on their other income. Think about that for a moment. If you and your spouse have $70,000 in taxable income, you could realize up to $26,700 in long-term capital gains and pay zero federal tax on those gains. Here's a practical example. Let's say you own stock worth $45,000 that you bought for $18,300. You could sell it all, realize that $26,700 gain, and potentially pay zero federal tax. But here's what you need to watch out for. This is only with taxable accounts, not your pension, DCP, a Roth, or an IRA. While you might avoid federal tax, Washington state does have a capital gains tax, so be on the lookout for that. This extra income could affect other tax calculations, including Social Security. Speaking of Social Security, let's talk about mistake number two: mismanaging your DRS pension, Social Security, and portfolio withdrawals. It's crucial to carefully coordinate these benefits to avoid unnecessary taxation. Let me break this down using 2025 numbers. For couples married filing jointly, if your combined income is between $32,000 and $44,000, up to 50% of your Social Security could be taxable. Above $44,000, up to 85% could be taxable. Here's a real world example. Let's say you're receiving $24,000 yearly from Social Security. If you withdraw $40,000 from your traditional IRA or DCP, your combined income would be $52,000, pushing you well into that 85% taxation zone. But here's the strategy that could save you thousands. Taking that $40,000 from a Roth account instead would drop your combined income to just $12,000, potentially making none of your Social Security benefits taxable. In a future video, I'm going to talk about the importance of having three key buckets of savings. And now, mistake number three: overlooking qualified charitable distributions. This one's especially important for those of you over 70 and a half, particularly since Washington doesn't offer a state income tax deduction for charitable giving, because we don't have a state income tax. Here's how QCDs work in 2025. You can donate up to $108,000 directly from your IRA to a charity of your choosing. It counts towards your required minimum distribution. This amount is not counted as taxable income, and you can also significantly reduce your Medicare premiums by doing this. But remember, this only works with traditional IRAs, not Roth, not DCP, or any other accounts. The charity must be a qualified 501c3. You also need to be 70 and a half or older, even though RMDs now start at 73. So here's why this matters. In 2025, Medicare premium surcharges start at $212,000 for married couples filing jointly. Using QCDs, you could help keep your income below these thresholds, potentially saving you thousands in healthcare costs. As a Washington State public employee, you've earned these benefits through your years of public services. Don't let unnecessary taxes eat away at your retirement security. Visit lifefocusadvisors.com to download our free tax guide specifically for DRS members. I specialize in Washington State retirement systems and understand the unique options available to you. Schedule your complimentary consultation today, and let's make sure you're not paying more in taxes than you need to. Remember to like this video and subscribe for more strategies specifically for Washington State public employees. Drop a comment below with any questions about your DRS benefits, and I'll see you in the next video.